Hey everyone, Mike Malarczyk here at New Fed Mortgage. So we're right in the middle of football season, and in the words of the somewhat great Pete Carroll, I'm super jacked and pumped to share with you how I'm saving a client of mine $668 a month by using a 2-1 buy-down strategy. So if you've been following me, and thank you by the way, you know that over the past few months, I've been talking about the benefits of utilizing this strategy to combat high interest rates, battling inflation, and try to bring affordability back into the picture for people. Well, today I want to explain to you in detail just how a 2-1 buy-down works and how it has really been a win-win for my clients on both the buyer and the seller side, and also my real estate agent partners as well. So for many of my clients, affordability is a major, major issue. And the fact of the matter is, rising rates have just put them in a position where those monthly mortgage payments are no longer comfortable or meetable at the price points that they're looking at, right? So, and I tell my clients this all the time, I never want you to be in a position where you're uncomfortable making a monthly mortgage payment. I never, and I mean never, want to see you eating ramen and peanut butter because you're stretched too thin on a mortgage. Because honestly, that's what happened to me when I bought my first house. I simply didn't know any better. I didn't have anyone giving me good advice. And I just, it happened. I mean, I got through it and that's fine, but I don't ever want to see anybody do that. Okay. So that is no bueno, no ramen. All right. So I want to show you exactly what I did for my client, and I'm going to explain it to you in detail so you get a better understanding of how this 2-1 buy-down works. So the way this 2-1 buy-down works is it's a seller concession or a seller credit, which funds what the buyer is saving during the first 2 years. So in this example, you're going to see here in year one, the buyer is saving $8,012.81. In year two, they're saving $4,097.20. So you add these two savings years together, and that is the amount of the seller subsidy, which is $12,110.01. So that is the amount that they are contributing to make this deal happen. And just on a quick side note here, in order to get that same benefit, the seller would have to drop their list price by approximately $36,000 to $40,000 to get this same benefit. So instead of dropping their price by $40,000, they're going to give up $12,000 in a concession, which makes a lot of sense to me. So what this does for the buyer here is, instead of having a 30-year loan fixed at 7.25%, and I know that's just where things are now, everything sucks, but it is reality, and this is what we're dealing with. So instead of being locked in at 7.25% for 30 years, that concession is going to allow them to buy their rate down in year one to 5.25%. Okay, so that's giving them a monthly payment of $3,827. That's saving them $668 a month. In year two, their rate goes up 1 point to 6.25%, but they're still saving $341 a month. Years 3 through 30, you go back to 7.25%, which is what you got to qualify at. Hopefully we won't get there, but that's for later down the line. Okay. Now here's why this is different from an ARM or an adjustable rate mortgage, okay? And which in my opinion are very risky. So with an ARM, your payment starts lower, but you need to understand that your payment is going to go up. Yes, it could go down, but more likely it's going to go up, and it could go up significantly, where in some of these ARMs, they have ceilings as high as 9 or 10%, maybe even higher. So in this scenario, you are never going to get above 7.25%. And in the first 2 years, you're saving a significant amount of money. So look, at some point, the Fed is going to have to undo what they've done here in 2022. They're going to have to do a course correct, a U-turn, if you will. Inflation is going to come under control. And as I've been saying now for quite some time, historical data has proven that mortgage rates always come down after a recession. So I can't promise you that rates are going to come down, but hear me now and believe me later, there's a very strong, and I mean very likely possibility that rates will come down in 2023. Okay, so what that means is when that does happen, you can go out and get yourself a 30-year fixed at, I don't know, 4.5%, maybe 4.99, who knows, maybe even lower, right? So what I tell a lot of my clients is, listen, if you love the house, marry the house, but your date and your rate. Okay, right now the goal is to get you in the home. Your rate is not permanent, right? When things change, we're gonna dump your old rate and find you a brand new, younger, better, lower rate for you. So let's say rates do go down a year from now, and this client of mine, they can get into a 30-year fix, let's say at 4.75. Okay, so in year one, they've saved that $8,000, right? And they're going to refinance. So now here's the cool thing here. What's going to happen to this $4,097.20 that they didn't use in year two? Okay, so that money is sitting in an escrow account with the lender. It's going to get credited back to the buyer in the form of a principal paydown, meaning that the remaining $4,000 or whatever is left over in the subsidy escrow is going to go towards reducing your principal balance when you refinance, which is an awesome, awesome deal. So how do you like them apples? So there are different ways you can utilize this strategy. There's permanent rate buy downs. There's 2-1 buy downs like this. There's even a 3-2-1 buy down option. But the most important thing, and I can't emphasize this enough, is that it must, and I mean must, absolutely be structured correctly in the purchase and sale agreement and here with me internally at the bank to avoid any high cost lending predatory laws or any compliance issues. If that's not structured correctly, you're going to run into problems. So it's super important that you're working with someone like myself who knows how to do this stuff and who does it on a regular basis. It's also extremely important that loan officers and real estate agents work together with their clients to do what's best for them and their families. And I say this all the time. If it doesn't make sense, don't do it, right? You know you better than anybody else, better than any loan officer or financial advisor. The best ones are the ones that are going to take the time to listen and pull that information out of you, find out what's important to you, what your goals are, and what you want to accomplish. Then we put together a loan program that's going to meet those goals and is best for you and your family. So I really think this is a really great product that's going to help bring affordability back into the market. I think it's going to help a lot of people get into homes at the end of this year into the beginning of next. But like anything else, it doesn't work for anybody. Some will, some won't, right? But it's at least worth having that conversation. So again, Mike Malarczyk, New Fed Mortgage. Please reach out to me, call me, text me, email, whatever. Advice is always free. Thanks for watching.